I took $1,000, split it between Bitcoin and gold. And what I found out wasn't just surprising, it was embarrassing because I had opinions going in. Strong ones. Turns out the data didn't care. Here's the problem with the Bitcoin versus gold debate. Both sides are so loud and so tribal. It's basically the finance version of Android versus iPhone, except this time, someone's retirement is actually on the line. Bitcoin maxis say gold is a boomer rock. Gold bugs say Bitcoin is a Ponzi. Meanwhile, retail investors like you are stuck in the middle, trying to figure out where to actually put your money. So I ran the experiment. And in the next few minutes, I'm going to show you what $1,000 actually proved and what it means for your portfolio right now. ACT 1. The battlefield. Here's how the experiment worked. $500 into Bitcoin, $500 into gold. Same entry date, same dollar amount, zero emotion, just math. Now, full disclosure, going in, I had a bias. I thought Bitcoin was going to obliterate gold. I mean, gold is a rock. A shiny rock that doesn't generate cash flow, doesn't pay dividends, and has been used as money since before your great-great-grandmother was born. How is that supposed to compete with a borderless, decentralized, 21 million cap digital asset that institutional money is quietly stacking? But here's the thing. Gold didn't get the memo. Over the last 5 years, gold has been averaging nearly 20% per year. Not gold's typical 6 to 12% annual return, the kind that made it the financial equivalent of a participation trophy. 20% per year. That's not gold doing gold things. That's gold telling you something is very, very wrong, and it recently hit all-time highs again. So, before I show you the experiment results, I need to show you why both of these assets moved, because the why is what should keep you up at night. Act 2. The data reveal both going up. Now here's the part of the experiment that stopped being about returns and became about something else entirely. I ran the numbers, and both assets were going up at the same time. If you know anything about how markets work, that sentence should make you slightly uncomfortable. Because historically, risk-on assets and risk-off assets don't move together. When crypto is going parabolic, people aren't hiding in gold. When gold is surging, it usually means people are terrified. And Bitcoin, which trades like a leveraged tech stock, should be selling off. But that's not what's happening. The S&P 500 is near all-time highs. AI stocks are priced like they've already replaced half the workforce. And simultaneously, gold is hitting all-time highs. Every asset class is sending a completely different signal. It's like everyone at a party is dancing. But the DJ looks absolutely terrified. So I started pulling the thread. Why is gold doing this? And more importantly, why? Why is Bitcoin following? Here's what nobody in the Bitcoin versus gold debate is talking about. For the third year in a row, central banks bought over 1,000 tons of gold. That's more than double their previous decade average of 400 to 500 tons annually. And 2024 marked the highest gold buying year in recorded history. Over 95% of central banks expect gold holdings to continue rising over the next 12 months. These are not retail investors. These are not gold bugs on YouTube ranting about fiat currency. These are the largest financial institutions on the planet, quietly and then less quietly moving away from the US dollar. 20 years ago, central banks held over 70% of their foreign exchange reserves in US dollars. Today, that number is down to 58%, a 12-point drop. And when we're talking about trillions of dollars across every central bank on Earth, that's not a rounding error. That's a signal. And where are those trillions going? Not the euro, not the yen, not the pound. Gold has become the monetary prenup, just-in-case plan, the asset you quietly move into when you still like the dollar, but you're also exploring your options. Asked 2, the pattern nobody talks about. Now here's where it gets interesting, and this is the part that changed how I look at this debate forever. There's a pattern in the data. Gold pumps first, then Bitcoin follows. I'm not making this up. Go look at the last 2 major cycles. Gold leads, Bitcoin catches up, and right now, we are entering the final stages of a gold pump. If that pattern holds, you can probably guess what comes next, and it makes sense. Because when you strip away the tribal warfare, the boomer rock versus Ponzi screaming, both assets are doing exactly the same job. They are alternatives to paper money backed by nothing but trust. Gold's version, physical, thousands of years old, sovereign, slow. Bitcoin's version, digital, borderless, mathematically capped at 21 million, fast. Neither can be printed. Neither can be frozen with a phone call from a Treasury secretary, and neither one answers to a central bank. That's not a coincidence. That's a thesis in the revelation. So let me say what the experiment actually proved and why it embarrassed me. I went in thinking this was a competition. Bitcoin versus gold. One winner, one loser. Pick a side. That's the debate everyone's having. That's what the YouTube thumbnails tell you. That's what Twitter tells you every single day. But the data told me something completely different. It's not Bitcoin versus gold. It's both versus the dollar. And central banks, the biggest players in the global financial system, are quietly agreeing. They're not choosing a side either. They're hedging. They're preemptively positioning. They're not reacting to a crisis that's already unfolded. They're hedging a future they don't fully trust. Gold doesn't rise when people are optimistic. Gold goes nowhere when stability feels real. It only wakes up when trust starts to slip. And right now, gold is wide awake, which means something, somewhere in the global financial system, is not as stable as the headlines want you to believe. Pay off fetch the 3 rules. So here's what $1,000 actually taught me. 3 rules I'm now applying to my own portfolio near, and I think you should too. Rule 1. Stop picking a side. Own a thesis. The thesis isn't Bitcoin. It isn't gold. The thesis is de-dollarization. Both assets benefit from the same macro tailwind. Fighting about which one is better is like arguing about whether to bring an umbrella or a raincoat when it's already raining. Rule 2. Don't dismiss gold because it's boring. Gold has returned nearly 20% annually for 5 years. If an AI stock did that, you'd call it a generational opportunity. Gold doing it? Somehow it doesn't count. That's a bias. And biases cost you money. Rule 3. Watch the sequence. Historically, gold leads, Bitcoin follows. We are in the gold stage right now. That doesn't mean Bitcoin is dead. It means watch the signal. And the signal is currently screaming. I'm not telling you to sell everything and buy gold bars. I'm not telling you to go all in on Bitcoin. I'm telling you what the data showed me, whether I liked it or not. If you want to go deeper on why central banks are quietly moving away from the dollar and what it means for your money, I'll put that video right here. And if this made you question which side of the Bitcoin versus gold war you've been fighting, subscribe. Because I'll keep showing you what the data actually says, even when it embarrasses me.